there are two types of options that you can buy. Call and put. You want to buy a call option when you think the price of a stock is going to rise. Okay? And you want to take advantage of this rising price, so you buy a call option. And for both of these options, you have to pay a premium when you sign a contract. I'll give you an example right now. Just remember this. Call is when you want to buy a stock that is going up, that you think is going up. Okay, you don't know for sure, but because in the future, you think it's going up, you want to buy a call option. If you think the price is going down, you want to buy a put option, so you can sell the stock. All right, example. Now, the stock price of our stock club is $50. All right. I'll draw a timeline at April 1st. 50. And then I want to buy 100 shares of $50 of the stock price. The premium out of a $70 call, that means I believe the stock is going to go up to at least $70. Okay? And that I have to pay a premium of $3 per share. So if I want to buy 100 shares, how much do I have to pay? $100 times 3?
300.
Yes.
I have a question.
Yes.
What is the strike price?
Strike price is the price that you believe is the price you pay. Is the set price you pay. For example, this one is $70. So at the end of the contract, if you want to execute the contract, you're going to pay $70. No matter what happens, if you execute a contract, you have to pay $70. Okay? Alright, let's say I want to use the contract today. How much do I have to pay? The price right now is $50, but how much do I actually pay? It's $70 per share. That's today. April 1st. Okay, even though it's $50 per share. It's not working. Yes.
So are you paying $73 a share?
Yeah. So that's a good question. Right? I have to pay $70 if I execute the contract, right? But actually I'm paying what? The whole $70 times 100 and my $300 cost. So am I making money? Not really, right? When do I start making money? Is when the price go up to $73. It'll cover my cost.
So do you always have to pay the $3?
Always, I have to pay once.
Oh, cool. Okay.
Always. What do you mean? Well, it varies. It doesn't have to be $3, right?
Mm-hmm.
If it has a higher potential to go up, it will be higher than $3. If everyone believes it's going to go up, of course you're going to pay more to buy the contract because you're buying it at $70. That's right now, that's it. Does everyone understand the background? Yeah? Okay. If the price goes up, now I'm at April 14th. Wait, let me see. Okay, to May 31st, alright? My contract ends at May 31st. I have from April 1st all the way to May 31st to execute my contract to April 14th. The price of my stock club, is at $100. Okay. Now, if I want to exit the contract right now, how much do I have to pay? That's right, $70 per share. You sign the contract, that means during this time until May 31st, until the last day, all you have to pay is $70, no matter what the price changes. If it goes up to $100, you only have to pay $70 to get $100 worth of share of the stock, right? So that's a $30 profit that you're making difference between the two stock prices. Yes.
So when you put in a call option,
Yes.
and it is priced at $3 per share, and you want to buy 100 shares, are you required to pay $300 right away?
Yeah. Yes. You have to pay it right away. Yeah. If you sign a contract, you have to pay it. Okay.
Okay.
All right. So that's if I end the contract right here. I pay $70. I get $100 worth of the thing I own right now. If I sell it, what do I get? Plus $30. Right? Yeah.
Why would I buy options instead of just the underlying asset?
You want to buy it at $50
No, but
and wait for it to-
why would I not just buy a stock instead of an option?
Yeah, so you want to buy
What's
at
the-
$50 at the first day and wait
Now,
for it to
what's the benefit of just buying an option instead of just a stock?
Yes, I'll tell you later. I'll tell you later the benefits. But first let me explain to you what it is. Alright, Phil? Be patient. That's only if your stock price goes up. Right? What happens if it goes down? Now, imagine yourself, you don't have to end the contract right there. You can say, oh, I think the price is going to keep going to go up. It goes from 50 to 100. I think it's still going to keep going up. Right? I'm going to keep it. What if it goes to, let's say, for example, 120? Right? I still only have to pay 70. I get an even bigger difference between the price. So maybe I should wait. Let's see what happens if I wait. If I waited. So on May 31st, I waited all the way till the end. May 31st. At that point, it's only worth $20 now. What can I do?
The
Yes.
stock is worth $20 or the option is worth $20?
The option, you bought it already. The price of the option didn't change.
Yeah, but
The
you can
contract didn't change.
You can resell options.
Yes, you can.
Okay.
Alright, so you think you're gonna resell options right here?
I mean,
Who's gonna buy your options at $70?
not many people.
Not me.
Okay. Well, but what are you gonna do with the option if you can't exercise it?
Exactly.
anyways? Why would you keep it?
Well, because I said it's going from 50 to 100. I believe it's gonna keep going up.
Yeah.
But it didn't. How do I know? I'm not supposed to know, right? It's the future.
Unless you're an insider.
Make
trader.
sense? Yeah.
Yeah, I guess so.
But so, yeah, unfortunately, it dropped to $20. Okay? What's gonna happen now? I have two options. One, I can exercise my contract and buy it at $70. Would you do that? I wouldn't. Okay? So how much would you lose if you actually did that?
A lot.
A lot. Minus 50, right? Per share. That's $5,000. Plus all the premium you paid. 300. With each of these, this is your cost. You have to pay no matter what. When you sign a contract, you have to pay this. The second option is that I never exercise my contract. I just leave it. So this, I don't have to do this. What if I leave it? I don't pay the $70. Well, this is paid at the beginning. If I don't pay that at the end, this is the only amount I lose. Make sense? So, for a call option, the dairy is confused. What's wrong?
You should pay $73 at the beginning. $73.
Oh, okay. So $73, that just means that when do I cover my Yes,
Let me
yes.
explain it to you.
No matter what, we have to pay the $300.
So basically, you pay the $300 to have the right or the option. That's why they're called options to
Yeah.
exercise, right? That you pay that $300 so that if the price goes up, you get to buy them at a specific price and then resell them right away, so that you can make money. But if it doesn't reach that price, then there would be no point exercising your option because, well, you'd be losing
Yeah,
money.
because, yeah.
So
it's worth less than you
that's
pay
why
for.
it's like a higher risk vehicle where you pay a smaller price up front to get more leverage, right? Because each contract is 100 shares, but you're not paying the price of 100 shares. So there could be much bigger kind of fluctuations in the price of an option. Does that make sense? Yeah.
So you buy the option
Yeah.
so that once the price rises beyond $70, you have the option to buy it at 70 because you have.
Yes, exactly, yes.
And then you
you
resell it right away.
You
Yeah.
can sell it or you can keep it. No matter what, you own something that you pay less for, right? So you own $100 worth of share with only $70.
Okay, so where does the premium? Because you said that it's $70 per share for the
Mhm.
option, and then you pay $3 premium.
Yeah,
So the $3 premium is the price you pay, which
to whoever sells the option.
but it's the price you pay for the privilege of being able to buy a share at $70 later on, right? So you have the option to do that. It's like you're not buying the share right now. You're paying for the ability to buy a share in the future.
Yes.
So that's what you're paying for.
Okay, that makes sense.
Yeah.
Okay? So, Lilia, make sense?
So before you bought 100 shares?
Before I buy 100 shares. What does that mean? When I sign a contract, I'm signing a contract to be able to buy 100 shares in the future. But I have to pay something for that contract. Okay? So for call options, I only profit when the price goes up. Right? Like the slide before, it says if you think the stock price is going up, you want to buy a call option. But if it goes down, what are you gonna lose? No one's gonna do that, right? What you're actually gonna lose when the price goes up is just your premium, which is the cost of the contract, right?
Because you don't own the actual stock itself.
Yes, exactly. Yeah. Okay. Now, so I talk about the call and the put, right? The put is essentially the same thing, but you have the right to sell a stock at the price that you determined. Okay? So if you believe that the stock price is going to go down, I want to sell it, I want to limit my loss, right? I want to sell it at a certain price. So if it keeps going down, I can sell it at that price. Yeah? Kind of. So what are the risks of option trading? For call holders, which is us right here, the upside is unlimited. Why? It can go from 50 to 100. It can go from 100 to 1,000, 10,000. The price can keep going up. There's no limit to the price going up. On the other side, the downside, the only thing you're gonna lose is the price of the contract, the premium, $300. Because you're not gonna pay $70 for something that's only worth $20, right? That's only loss. And in summary, the increase in the stock price when you buy call option, the increase in profit, right? The more it goes up, the more profit you're gonna make. Wait. Okay. For put holders, the upside, for example, I want to sell something at $50. own this stock, I want to sell it at $50. Because why? I believe it's gonna go down. I don't want something that's worth $50 right now, that's gonna worth like $20 in the future. I want to stop it at $50. That's my example. It's worth $70 right now. And my put option is at $50. So it goes down to 50, I want to end it. I can sell it at $50, even if it's worth less than $50. So my prediction of this stock is it's gonna go down, right? What happens when it goes down? Let's say it goes down to $50. I sell it, nothing's lost, only the premium that you have to pay. Right? Just as before. If it keeps going down from 50, go down to $30, for example. I'm selling other people something I can sell. This is my right to sell. No matter what, I'm gonna sell it. At $50, when it's only worth $30, right? I'm selling something at a higher price than it was actually worth. And this is a profit I can make. Yes? However, just like before, if I made the wrong prediction, my put option goes up. Right now it's $70, what if it goes to $100? Right? I can wait until it drops in the future, or I can just leave my contract and just pay the premium. I don't know. That's a problem. The upside of that, however, is limited this time. Because why? I keep going down. $30, I go to $10, I go to $0, bankruptcy. You can't go below $10, $0, right? This is the profit that you're gonna make for sure. However, your cost, your loss, is gonna be the same. Because if you don't exercise the contract, that's the only thing you're gonna pay, no matter what, $300. Yes? And in summary, the decrease in stock price when you buy a put option is increasing. And to answer your question, Phil, why do you buy options? First of all, cost efficiency. That's where I example here. The stock price for Stock Club is $70. For 100 shares of $70, that's $7,000. I don't have $7,000, but I really like this stock. I think it's gonna go up. Right? I value it very much. But I only have $50 per share, which is $5,000. That's when I can buy a call option. So I only have to pay $50,000. I mean $5,000. Right? So I pay less for something that's gonna work more in the future.
Yeah, that makes sense.
Secondly, high potential return. Buying calls, like I said, the price will go up forever, right? The profit is unlimited. Go up forever, it's so high potential return. If you made the right prediction, and if you have the right timing of when to sell it, right? Because the difference between selling here and selling it at $20 is a big difference. So you have to know the timing very well, and then you can have maybe a high potential return. But the good side is, no matter what, your loss is the same, $300, right? So if you have that spare, then maybe you can try out options. Yes? Questions?
Okay. So now, wait, we have the clicker? Or?
It didn't work.
Okay. So now I'm gonna talk
It
about.
didn't work.
I clicked on it.
Oh.
Here. So now, here, let me have the marker. I'm gonna talk about bonds. So, compared to options, bonds are like a much safer investment. So it's kind of like a pretty big contrast because options can get really risky. I mean, I always say that options is pretty much just glorified gambling. But bonds are like pretty much the complete opposite. So let's talk a little about that. So what is a bond? So a bond is a loan that you give out to a government or corporation in exchange for an interest rate. So pretty much, if you think about it this way, like when you're applying, what? Yeah. So when you're applying for like a mortgage or something, right? You're paying a percentage of your mortgage in interest, or basically it's the fee that you're paying for the right to borrow money. But bond is pretty much the opposite. You're lending out money to the government so they can pay for stuff like expansion and things like that, or a company if they want to raise money. And then in exchange, they pay you the interest. So basically, you become the lender. So they're generally pretty safe investments with a fixed payout. So compared to like stock market, like let's say you invest $100 in the stock market, you might never see that $100 again, especially if it's in Dogecoin. But with a bond, you will always get your principal back. Principal being the amount of money you pay initially, right? So let's say I buy a $1,000 bond. There's a very low chance that I'm never going to see that money again because the government typically does not stop paying their debts out unless a teenage girl with 3 credit cards. They typically have like a much better history than that. So they're very safe as an investment. But in contrast, to stock market, which has more risk, they have lower returns. So it's pretty much, it's about the risk profile. So let's talk how to buy bonds. So it's pretty simple to buy a bond. You can buy it through a broker, like Wealthsimple or like TD Trade, something like that. Or you can just buy it directly from the issuer, which is typically the government. So you think of like treasury bills in the US or things like that. And you can just buy it straight from them, or you can use a broker to facilitate it. There's also something called bond-based backed assets. So like a bond ETF, so it's an exchange traded fund which contains a bunch of like bond-related stuff, and it can have similar returns and safety to bonds. So you can diversify in that sense too. So let's talk more about interest, because I feel like a lot of people don't really understand like the underlying concept of bonds. So an interest rate, it's the fee you pay by the borrower to the lender for the privilege of borrowing money. So let's say I want to buy those $600 Lululemon pants, but I don't have the money to do it. So I'm going to pay a fee because I need to borrow money to afford that. And that's what's called the interest rate. And the higher it is, the worse it is for the borrower, but the better it is for the lender. So it's a cost for the borrower, typically, and income for the lender. So let's say there's a 5% interest rate. On my Lulu pants, let's say they're $100. I'm gonna pay, after 1 year, let's say, if the interest rate is 5%, I'm paying $105 at the end of that. But the lender receives that $5 in exchange for giving me that money, because they could have done something else with it. They could have bought their own Lulu pants. So that's why it's a cost for the borrower and income for the lender. And the way that bonds work, a way for consumers to become the lenders, because I can't really start giving out car loans because I'm too poor for that. Like, I'm not an institutional lender. So bonds are really, it's a way for normal people to become the lender and give out debt, pretty much, and then they receive the interest for that. So let's talk a bit more about interest rates. So we talked about how a bond is a loan that you give it out to government for an exchange for interest rates. But why would someone pay an interest rate? Like, it's because money right now is worth more than money later. So if you think about it, if I have money now, I'm willing to pay more for that right now, because then I can use that to buy other stuff right now, which might make me more money. So that's why interest rates, but they also vary depending on government policy. So the central bank can set interest rates, which then affect the price of bonds. So let's say the central bank rate is 5% in Canada right now, around that. So that means that for the lowest price it's going to be to lend out money is going to be 5%. So you're not paying any less than that. So that's why, let's say, a mortgage is so expensive right now. It's because the central bank set the interest rate much higher than it was before. And typically, the interest rate is close to the real interest rate offered on loans. So let's say a bond is going to be typically a bit lower than like a normal interest rate, but that's because it's such a safe investment. So that's kind of like the trade-off for it. So but it's pretty close to the interest rate on some other stuff. And these interest rates, they can impact the economy in different ways. And in some countries actually have negative interest rates, like Germany, where they actually pay out the borrower. So let's say you buy those Lulu pants, you're actually only gonna pay back, let's say $95 instead of $105, because they want to stimulate spending to kind of reduce inflation or to increase economic growth, because high interest rates would reduce inflation. Let's talk a bit more about that. Daniel, do you want to tell me what inflation is?
I don't know.
You don't know? So inflation is when everything goes up. So when I wanted to buy those Lulu pants like 5 years ago, I would have paid maybe $90. But today, since the government did a bunch of silly stuff with the money, it now costs a lot more. Yeah?
What did it do?
Stuff like printing money and low interest rates typically will boost inflation. They'll rise prices, because think about it this way: if the interest rates are really low, that means it costs very little to borrow money. So if I want to borrow money and interest rate is 20%, let's say, maybe I'm not gonna spend money on a house right now, because it's gonna cost me so much more money in just interest or paying for a loan. So then a lot of people would maybe say, okay, well, I'm not buying a home right now just because it's so expensive. So the demand for homes will get artificially lowered because it's more expensive to take out debt, meaning that the supply wouldn't really change, but the demand would, which would lower the price of things. Does that make sense? So but when interest rates are low, it's really easy to take out money, right? Let's say you only pay 1% interest for that home. It incentivizes me to take out a loan and buy that house just because it's so much cheaper. So that stimulates demand, which can raise prices because it's easier to get access to money. So in the same way that printing money would devalue money, making it easier to access large amounts of money for cheap, right? Money now, and you don't pay a lot for that privilege, then that makes it a lot cheaper to spend, and then it raises prices artificially. Do you understand? So yeah, if borrowing is cheap, consumer spending rises and price rises. So let's say if the white girl named Jessica wants those Lululemons now, and it only costs 1%, she said, to take out a credit card debt. She's like, oh my god, I can just buy it now and pay it later. But maybe Jessica would think twice if she had to pay 20% of her Lululemon pants at the end of the year. Maybe she would think, oh, why would I pay $20 just for the privilege of having these now? I'll just save up for it. And then if there's 1,000 Jessicas out there, maybe they're not all gonna spend that money on Lulu pants and save. So that's why the government, if they want to control the economy by slowing it or speeding it up. So during COVID, they dropped interest rates really low because they wanted people to spend money, because a lot of people lost their jobs and the economy was slowing down because there wasn't much trade happening. So they lowered the barrier to borrow money, which just made it easier to spend. So, but now that the economy is back in like a better shape, they're raising interest rates because they don't want the price of everything to keep going up. So it's really just a balance. It's a tug of war between interest and inflation. The interest rate, one last thing on interest, is it also dictates the return on low risk saving vehicles. So like, let's say your savings account. A high yield savings account right now maybe gives 4% every year of interest, right? Because the bank is taking your money and they're doing other stuff with it. They're investing it, they're giving it away, and then you can take it out at any time, but they're leveraging your money. So they pay you for that privilege. So in a really low interest rate environment like Germany, which I think their interest rate is negative 0.25 right now, it actually costs money to save, or if it's on a high interest environment, you can lend out money and get paid a lot more, so it's better for the lender. Any questions on that before we move on to Daniel, where he'll talk to us about money?
Alright, so thanks for bearing with us so far. So I understand there's a lot of terminology, right? There's like bonds, options, so many words. But I think what many people don't actually understand is, it might be a silly question, but what is money, really? And if I ask you right now, Joshua, do you have money on you? Like, I'm not gonna rob you or anything, but you don't have money on you. Yeah. And that's likely true. Do you have any money on you? Yeah. It's okay, you don't have to answer, but the truth is, you actually don't have money on you right now. And I just want you to keep that in mind for now. And now, what is currency? Because we just looked at money and currency. Like, what is the difference? Do we have any thoughts? Any thoughts? Currency, money, right? They seem to be just terms we always throw around, right? I have money, I have currency. That doesn't sound very right. And so that's a little hint for you right there. So, currency is a medium of exchange. So if you think about your cash right now, that is what you call currency, right? Whereas money is not necessarily that. So think about currency is going to be small, it's portable, it's divisible, and you can always count money. So if I take chair to be currency, if I want to buy a piano or 5 chairs, I would say that's not very feasible because first of all, I'll have to carry 5 chairs. And so that is why the government or some very intelligent people, they created something called cash, right? They created paper so you can put in your pocket and say this paper is worth about 5 chairs. And that gives you a breakdown of currency. But what is money, right? Money is a bit different. It is every aspect of currency. Yeah, Phil?
Is a pixelated monkey NFT money or currency?
It's a very good question. And I think you'll all be able to answer that right after you read the next few slides. And so there's going to be a bit of thinking when you take the words money and currency and really compare the two. Because money is an asset, it's a store of value. And so currency can be worth nothing, whereas money can be worth a lot more. So think about currency and money. So just let it brew in your heads for now. So some examples of money are oil, silver, and gold. And personally, I've never seen any store say, I will sell you chips for 5 grams of oil, because that just doesn't seem very safe for them. Or gold and silver.
Cool.
And so let's talk about the key differences. So money has real, genuine value. So if I take a piece of paper and I go to some person in a faraway island and show them a $5 Canadian bill and say, this is worth a lot to me. But they might see it and say, this is just a flimsy piece of paper, right? But what if I take money? What if I take a gold bar to the same person? They might see the gold bar and say, this gold bar is worth something to me. Although the gold bar is only worth $5. Just an example, it's probably worth a lot more than $5. So that kind of brings it, you see that money is almost natural, right? And so if you've taken physics or science, you learn that energy is neither destroyed or created. And so that gives you wealth. Wealth is a little bit like energy, right? Like energy, question mark,
Yes.
think about. So wealth, like energy, is not created or destroyed. Like how that even work? So when humans first appeared on Earth, or maybe they evolved from fishes, was the wealth already there? Was the Canadian dollar already there? Were there billions of dollars just on Earth left for us to kind of just take, first come, first serve situation? Well, not exactly. So since wealth is never, actually before going into wealth, let's talk about what is wealth, right? And how does wealth work? And you realize that since wealth is never destroyed or is created, the only time people actually make money is when there's a transfer of wealth. And I want to take you back to the fall of the Roman Empire. I'm sure it's something that we often think about when we're on our own. So what happened with the wealth transfer during the fall of the Roman Empire? So those of you might know that the Roman Empire were a very powerful empire. group of people, right? They had lots of access, they had very nice bridges and bathrooms and buildings. And so when the Roman Empire fell, all of their money was transferred to the barbarians. And it's because the barbarians invaded the Roman people. And so they no longer have that power. They no longer have that level of wealth. And don't worry if this doesn't make sense for now. It takes some time to really get into your head. It's very similar to theoretical physics in a way. And the Industrial Revolution, right? So back in the Industrial Revolution, the working class had most of the money, right? People like you and me, commoners, people who build bridges, people who clean bathrooms, people who make bread. Those people had the money, right? Factory workers. But then all of a sudden, some guy comes in and say, I have just built new technology, and we don't need these factory workers anymore. And all of a sudden, the wealth from these factory workers, these commoners, were suddenly transferred into the people who had better technology. Now talk about the dot-com bubble. So what happened there, right? So we all know like companies like Google, Apple, all these tech companies. Well, when they first came out, there was so much talk about it. People were so excited to invest. It's almost like crypto. People were so excited to say, I trusted all of these companies. So back then, there weren't really any regulations. So if I started a company that was a technology company, and I said, I need $1 million. All of a sudden, an investor would suddenly rush in and give me $1 million because all technology companies were growing so big and so fast, everybody believed that technology companies were the thing of the future. But then all of a sudden, when it happened, the price went all the way to the roof. So if you were an early investor, say you invested in company A when it first started, a share might have been $1, but then all of a sudden it's $1,000, right? And so your share grew from $1 to $1,000, so it grew by a lot. But then all of a sudden, let's say you're gonna come in, and then you say, oh wow, the hype is great. I believe that at $1,000, it's gonna go even higher. And so all of a sudden, people realized that they were too overvalued, right? People didn't want to pay for technology companies anymore, and the price went straight back down. And so what happened here was because I went from $1 to $1,000, I made a lot of money. I got out there, and I'm done. However, you as a new investor, you were a bit too late into this whole technology game, and you lost all your money because the market just crashed completely. And just one last example, talk about the 2008 financial crisis. So what happened there? So this happened when the government was effectively not managed well, I would say. And so a lot of financial institutions and banks, they became broke. And when banks have no money, and I can go to the bank and say, I need to borrow $20, and the bank says, I have no money, then it becomes a bad situation for everybody. And so what happened was the government took money from us, from taxpayers, and they used that money to fund the banks. And you see here, the wealth transfer was from the general public back into the government and into the financial institutions. And so, just to say one more time, that wealth is not created or it is not destroyed. It has always been there. Right? Money is an asset. It is not something you can carry around. However, currency does not necessarily have value. Right? A piece of paper. What does that mean? Let's go into a bit more detail. Have you guys heard of the gold standard before? Of course, someone like me, they might call it the gold standard, but that is actually not what the gold standard is. So, any other questions?
No, other than that.
So, not right now, but long ago, gold equaled money. If you had $100 American dollars, you could trade it for a certain amount set in gold. And so there was actually value to money. Because instead of carrying big bricks of gold, you would say, I carry this paper, and this piece of paper represents a big block of gold. And so that gives money a currency, that gives currency, the US dollar, money, the value that is tied to it. It's almost like, how to explain this is when you go to the dry cleaner, you have your suit, you give them your suit, they give you a receipt. And that receipt is equal to your suit. You're going to exchange the two very easily. You can go to the bank and say, here, $10, I want my worth in gold. However, war happened, right? Tanks, bombs, World War I. And all of a sudden, the government needed to make more tanks. They needed to make more planes. They needed to make more bombs. And so they started printing a lot of money because the government assumed that commoners don't know anything about money. Right? So they printed money and they realized they don't have any more gold to back it up. Because every amount of money, every amount of US dollars, need to have a certain amount of gold to back it up. And so just for the war, the government said, okay, we're done with the gold standard, we're just gonna print a bunch of money. And so with this, the economy kind of went down, it started getting weak, right? Money was becoming more worthless. And so what happened? Well, in 1944, just a little bit of history here, the US government, along with a bunch of other countries, they came together at a place called Bretton Woods, and they discussed, all right, all of our economy is about doomed. What can we do about it? And since they don't have enough gold to back it up either, and there are just so many currencies in the world, right, they came up with one solution. They shook hands, and they came up with the idea that they should put the US dollar back into gold. And so now, just to go back here, the US dollar wasn't worth as much as it was before. Before, maybe $10 could get you a pound of gold. Now, $10 could get you 3/4 or 1/4. These are just very off. Don't expect to get a pound of gold for $10, but you get the idea. And so with that, the other currencies decided that they would tie their currency to the US dollar. And so US dollar is tied to gold, the other currencies are tied to the US dollar. And so it almost seems like everything is tied to the value of gold. However, so that's the exact number. So it's $35 of US dollars you can get for an ounce of gold. However, there's a lot of pressure, right, with that. I mean, the more money they need, the more gold they need. And governments often need a lot of money just because things always happen. And so during a time in the US history, during the Vietnam War, around that time, the US was facing too much pressure with printing enough money to match the gold, or having enough gold to match the currency, the dollar that they're printing. And so Richard Nixon decided that they no longer need the gold standard. They got rid of it. And so here's a very interesting fact. So since Richard Nixon took gold off the US dollar, what is the US dollar really worth? It's just a piece of paper now, right? Because if I have a piece of paper, before I could trade it for gold, but now it just seems like it's a piece of paper. And here's a very fun fact. So there was a story about this one person who worked in history, and he was tasked to sort every single currency from A to Z in history. And so at letter A, he went through about 250 currencies, and he found that they're all not tied to anything. They're all called fiat currencies, similar to the US dollar now. And he found that every single currency that started with A in history, the value now is 0. And so he went to B. And when he went to B, he found that every single one went to 0. And he spent more time and found that every single currency in history so far that is not tied to anything has gone to a value of 0. And so that brings you to the question, right? What is money? Why do you invest in anything even real? And so this might be like a bit philosophical, but what is money worth, right? What is a dollar worth today? Why is $5 not worth $10? And why do we have numbers assigned to these pieces of paper, these numbers in your bank account? Right? What is your money worth to you? Thank you. I just want you to think about that, and good luck. Any questions? Yeah? Cool, we all that makes perfect sense. Yeah.
Yeah.
Don't worry though, like, I'm sure you can still buy a car with money. It won't be worthless anytime soon.
Probably worth.
Yeah, so like that's why like, before you invest, just really think, what am I even investing in, right? What is money? Questions? Any questions? Concerns?